is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott. Andrew Young is off this week. As listeners of the show will surely know, we do talk a lot about crypto and related technologies, the broader constellation of what we describe as Web3. But we're also living in this very interesting period in human history. You know, every once in a while, a new technology emerges that bursts onto the scene and changes the way we think about the world, upends business models, transforms culture, society, and so forth. And we're living in this very interesting period right now where there's not one technology, but several, all basically emerging at the same time. Technologies like artificial intelligence, which are reimagining what we thought computers could do, from machines that were communication devices or for data retrieval, data processing, to devices that can think and reason, do tasks, provide comfort, maybe even feel emotion. We're seeing the rise of blockchains as a technology, which is really the first sort of digital medium for value. But we're also seeing other kinds of transformations in robotics, energy storage, and so many other different areas. And I think it can frankly be very bewildering as an investor, trying to figure out how do you get exposure to this stuff? Where do you identify opportunities? Now, this isn't an investment podcast, but we do talk about some of these big themes and drivers. These aren't things that matter quarter to quarter or month to month necessarily, but they do matter year to year and decade to decade in particular. And so we're actually going to sort of zoom out and do a deep sort of, or I guess like a big overview, and then hopefully a deep dive into some of these main drivers. And we have really the perfect guest to do that. Longtime friend, Brett Winton, who is the chief futurist of ARK. ARK, as many people will surely know, is a global asset manager specializing in thematic investing in disruptive innovation. The firm is rooted in 40 years of experience in investing in technologies that aim to deliver outsized growth as industries transform. ARK today has around $7 billion US of assets under management, and Brett is one of the people who's been there since day zero. He's the chief futurist of the company and has been there for almost 15 years. As chief futurist, Brett drives ARK's long-term forecasts across convergent technologies, economies, and asset classes, helping ARK dimension the impact of disruptive innovation as it transforms public equity markets, private equities, crypto assets, fixed income, and the broader global economy. Brett, we're so delighted to have you. Brett was a great asset to me during the research for my latest book, Web3. Continues to be one of the most eloquent and forceful evangelists, I think, for emerging technology, and backs it up with terrific thought leadership and research. For people who haven't read ARK's reports, they, I think, are really required reading if you want to understand how all these technologies are coming together. Okay, Brett, that's enough hype from me. Just so happy to see you. Welcome to the show.
Thanks. Thanks so much for having me.
So let's talk a little bit about the evolution of your thinking. You know, ARK was formed in February of 2000, or you joined in February of 2014, and here we are 10 years later. In 2014, crypto was maybe a $10 billion market, right? If it was a public company, it would have been probably the size of, the Gap. I think it would have maybe cracked the S&P 500. And AI was a technology that a lot of thoughtful people were working on, but had not broken into the mainstream the way it has today. And I'm just wondering, how has your thinking evolved around what the key drivers are for major disruption across the assets and industries that you're interested in? Has it changed over time, and if so, how?
Yeah, okay, so that's a good question. From inception, we actually correctly categorized, I think, the 5 major innovation platforms that we think are upturning the market today. So energy storage, robotics, public blockchain, multi-omics sequencing, as we call it, and then AI are, we think, 5 major buckets that think of it as like buckets where future historians will look back and say, I can't believe that all 5 of those things were hitting a critical stage of inflection over the same couple of business cycles. Now, I will say in 2014, we actually didn't have public blockchains split out. We had
Right.
a bucket of things we called next generation internet, and we thought what was happening on the fintech side, including with Bitcoin and crypto assets, was a portion of that. But within the first year, we actually, created a blockchain lead inside the organization, Chris Berniski, who went on to found Placeholder, because we realized how disruptive that technology was. So from within the first year, basically we had identified it as a separate category of disruptive technology that was interesting. And the reason I think we're good at identifying those things is because we have relatively like a consistent set of criteria that we apply that then we use to model and understand and forecast and dimension forward. And so all of the disruptive technologies follow steep cost declines. They cut across sectors and they're themselves platforms of innovation. And so a lot of our quantitative work is in understanding the shape of those cost declines, doing unit economic cases for different in-sector buyers, and we do what we call convergence scoring, but it's really measuring to what degree these technologies are cross-catalyzing and catalyzing other innovation. And so we apply that across the technologies to help identify and figure out how big they're going to be, or are people overestimating their potential impact? Now, underlying those 5 technology platforms, there's right now kind of 14 discretely modelable technologies that we focus on. And those have evolved over time, and we've gotten some of those wrong and some of those very right. And so kind of on the right side, from the beginning, we've been focused on artificial intelligence and how that's kind of changing the way that people can work and operate. And clearly, over the course of the last 2 years, suddenly the breakthroughs have become meaningful enough that every company in the world is being asked about how they're deploying the technology on their conference calls, regardless of what sector they're in. And across technologies, that's the advances in artificial intelligence are really accelerating all of the technologies that we look at. So that's our framework has remained the same. The way in which we've broadly categorized what we think about has been consistent over time. And there are things that we've learned from this capital market cycle. And there are ways in which we've thought about kind of who are going to be the beneficiaries of the different technologies that have shifted over time.
Yeah. That's so interesting. I think about the convergence of these different technologies a lot. One of the names that ARK famously got right was Tesla, long before I think a lot of people were catching on to what the impact was going to be of a company that was basically going to sort of change an automotive industry, or an industry in this case, automotive. But Tesla is not just a single industry kind of disruptor, right? It involves AI, energy storage, robotics. There is no Tesla without the battery, or without the assisted driving, or without the sort of manufacturing process, which is extremely automated. And so I often think a lot of people try to become educated on, okay, AI, how's this going to change things? But you really do have to think about how these different technologies come together. Has anything that, from your experience since you folks started out, really surprised you about just how these different technologies start to click?
Yeah, Tesla is an interesting example because, we have underwritten the business as a robo-taxi business, as that being the business that was going to drive the majority of the value. From at least 2017, we identified basically if they cross a critical threshold of being able to go from selling individual vehicles in a capital-intensive kind of pretty narrow margin basis, traditional auto is not a great business at all, to being able to deploy a software update to their entire fleet that allows the owners of those vehicles to effectively rent them out to riders in a way that is, cash flowy to the owners themselves. And then Tesla is able to extract a platform fee off of that. The entire business prospects transform for the company. And when we first began laying out that case, Tesla, it was not clear that Elon Musk even believed that he was going to be able to cross that threshold. And Tesla certainly wasn't saying that was their strategic ambitions. And then the evolution that's happened is over time, they've begun to design towards that strategy. And now it's gotten to the stage where Wall Street is starting to bifurcate into kind of like the justification for owning the investment has to be a belief in the robotaxi strategy. We can underwrite the individual EV business conditional on them not delivering robotaxi in a way that still actually makes it quite attractive given kind of how well positioned they are. But it's suddenly become like the thing that analysts actually are focused on. Sell-side analysts and kind of the individual investor and frankly, the management team and the CFO suite and everybody. And so it's interesting to see how much that company's prospects have now been kind of admitted to be dependent upon advances in AI and their ability to operationalize AI into their business. Whereas we've always thought that's where they were going to get to.
Yeah, it's so interesting. Like, I know you know the NVIDIA story front to back, but Jensen Huang on it was either the last conference call, was talking about how automotive was basically like the biggest driver of GPU orders, which of any single industry, which I thought was so fascinating and also very revealing, right? About just how much AI goes into crossing the chasm, if you will, from where we are today, sort of semi-autonomous assisted driving to fully autonomous driving. Feels like those two things are intertwined.
Well, I think you can very easily dimension a huge volume of cash flow coming off of turning on robotaxi. Like, think about just like how wasteful the current driving business is. Like, I spend average new car in the U.S. is $45,000 or something like that, which seems very expensive, by the way. Okay, so you spend like $45,000 or $50,000 for a car, and you're going to leave it parked 95% of the time. And the times that you're operating it, you are like really wasting your brain to like manually operate this vehicle from place to place. Like, it's an incredibly wasteful system as currently designed. And so there's an obvious, like, there's both an analogy to historical innovations where like really, really amazing economic productivity delivering innovations take non-market labor and they turn it into a market activity. So famously, like the washing machine for clothes basically allowed housewives to have the time to actually get other paid work rather than having to use a scrub board to scrub clothes all day. Right. And so kind of you took non-market activity. This is the person who's having to stay at home scrubbing clothes, turned it into a market, which is you buy the washing machine and pay to run it and pay to have it serviced and repaired. And then you create additional labor for the labor force. So in driving, we have non-market activity. We're all amateur drivers, some of us worse than others. And if you look at kind of like time use studies, people are roughly willing for personal use to spend half their wage rate to kind of substitute something they weren't getting paid for to paying for something. And so you can use that to get to, there's a $1 trillion market at $1 per mile in driving substitution in Western markets. And so if you think about suddenly creating a $1 trillion revenue service out there, that is almost the same size as the entire global automotive sales business, but it's at much higher margin. So on an actual market cap creation basis, you create an industry that is as large as the auto sector and actually materially larger. We think it's going to get to $10 trillion in sales. So then much larger than the entire energy sector on the basis of crossing this threshold in terms of capability where the car can legitimately drive itself at a reasonable price to end consumers. And so kind of like there's a reason that Tesla is buying a bunch of GPUs because they know that if they can cross that threshold, it's a massive value creation event for them. And other smart players in automotive are saying, oh my gosh, if they do it, we better do it as well, or else we're going to die. And so it's not just hey, there's a big end market out there that means you can get good ROI on investing in GPUs because you need to get across this threshold. It's also an extinction event for a number of different industries when that threshold gets crossed and begins to diffuse across the transportation landscape. And so there's not only a, hey, this would be nice to do, but also there's a real sense of urgency in that if you are left behind, if somebody else has that capability and you are, Ford, your business is effectively over. Like, it's hard for me to imagine the traditional automakers surviving without an extreme wave of consolidation and bankruptcy contingent upon, Tesla crossing that threshold.
Interesting. You talked about the washing machine and the washboard example. And what I find really interesting about that is that increased labor force participation, and that had an impact on GDP growth. And it's, these big transformations, especially with new technologies, often lead to great leaps forward in growth and also in productivity. But we've also seen in the last sort of a few decades with the internet, the first era of the internet, that though the internet has been immensely disruptive and has minted, multi-trillion-dollar companies and has changed every industry, we haven't seen, or like a lot of people would comment, like there's commentary out there that basically like it hasn't corresponded necessarily to like a huge leap in labor productivity or a huge leap to GDP. And I wondered about this because I think in one of your recent research reports you talked about how some of these disruptive technologies that are all coalescing at this exact moment could help to increase GDP growth from 3% to 7%. And I wonder how you get there. What is the basis of that analysis? Because a lot of, if cars, which are 95% latent most of the time, sitting in garages, and in driveways, are out ferrying people around, well, that might mean that many fewer cars need to be sold. And that actually has a weirdly opposite effect. Just in terms of production, there might be fewer cars on the road, right? So like, how do you reconcile the way in which it's disruptive from that perspective, but also can lead to growth?
Yeah, so it's actually like there are plenty of examples of things that like they're clearly human utility increasing, but not GDP increasing. Like think about the music.
Well, I think about like the iPhone. There's this, the joke with the iPhone. It's like it's your MP3 player, your PC. It's the stack of CDs. It's the pile of this, that, and the other thing. And it's like media, DVDs, and so forth. Like you don't have to buy any of those physical things anymore. Everything's compressed into this single form factor. And you still have to buy streaming services and so forth. But you're no longer consuming as much stuff because of the fact that technology's improved.
Yeah, or like think about pictures. So there's something like I think it's 2 trillion pictures that were taken last year, and at peak of the actual you print out pictures era, it was like 80 billion pictures taken, right? So, wow. But that's been actually a massive GDP reduction because previously you were paying to get them all printed out. Now it's effectively free. And so, but clearly from a consumer utility perspective, hey, this is much better. I'm not getting duplicate shots of my roll, half of which I don't like. I'm getting a lot more shots to select from, and then I get to see and retain the ones that I really like. And I'm paying some in cloud storage for that, but it's not nearly as much as I was previously paying to, Kodak to print them out, right?
Totally.
And like also what's interesting about that example is just within the past 5 years with AI, all of that excess pictures that were being, produced are actually useful to train these AI agents to generate images and to understand the world. And so not only is there a consumer surplus there, it's actually the feedstock for all of these models that we're using. And so there are plenty of technologies that I think effectively are mismeasured by GDP, as in it's clearly net better for me, or there's dispersion between GDP measurement and actual human utility on the back end. Now, with that as the context, like how can I state that kind of like actually I think measured GDP is going to increase on the basis of the technologies.
That old measure, the metric that maybe doesn't fully capture the value, right? Like that's the thing that you're talking about potentially increasing from 3 to 7.
Right, and it's just on the basis of our robotics forecast and our robotaxi forecast that I make that claim. Actually, including, if I included what we expect to happen with AI, all of the productivity improvement that's going to deliver to kind of the enterprise and consumer software side, we end up with a much larger number than a move to 7%. But my assumption is that's actually not going to flow through into the GDP statistics in a directly measurable way. And so, and also, by the way, not just AI, also, what's going to happen with public blockchains. Think about kind of the capital efficiency of being able to basically kind of allocate capital to the place where it's most needed more quickly, being able to do risk transformations, auto-executing risk transformations through smart contracts that previously, were very costly. You'd have to go through an investment bank to do it. And so most people wouldn't do it because the fixed cost is way too high for people to do it. Think about everything on multi-omics, extending human life is actually, it's not, directly GDP. In fact, it could be GDP destructive, as in its end of life is very expensive. So if you could have people kind of get in car accidents and die and all that kind of stuff, that's actually a lot of money that flows into the traditional healthcare system, and is avoiding car accidents is actually bad for GDP because you don't send people to the hospital and you don't have to replace and repair the vehicle. So there's all kinds of ways where it's mismeasured, but it tends to measure things in the real world production way much better than in the kind of digital creation of value way. And so within robotics, we think that household robotics is another area like the washing machine where people will pay for a service to avoid doing things. And so then that'll flow through to GDP because you're taking non-market activity. On average in the US, people spend 2 hours a day doing housework amongst adults. It's actually quite a bit. If you figure out the full labor cost of that's not accounted for, it's very high. And so we think that people will, you can get to where the median household would be willing to spend $20,000 to $30,000 for a household robot that just does half of their housework. It doesn't even have to do the whole thing. And then it'll be used for all kinds of other things. Could you please pick some weeds for me, or just pick up leaves one by one off the grass because I don't like hearing a blower blow leaves, which, by the way, I'd pay for. And so there's lots of kind of house activities that don't get done that you would prefer to have this thing do for you. So that's one big bucket. And then the other big bucket is this transportation piece, where we think that there's going to, if you think about global GDP is around, I don't know if off the top of my head anymore, 130 trillion? Ooh, I don't know. Global GDP is above 100 trillion, right? And we
sounds about
right. There's going to be $10 trillion in addressable robo-taxi market. And so kind of that of itself is a one-time kind of 10% boost to GDP, because most of that is taking away from non-measured activity. And so you can imagine that between that and robotics and kind of the time labor that you free up by doing that 10 trillion that causes people to be able to work more, you end up with a meaningful boost to GDP, inflecting really over the course of the next few years. And if you look at the long scope of history, it's actually expecting GDP to stay in this 2 to 3% range perpetually. And in fact, in the traditional forecast, it tends to decay over time, down to 2% by the end of the 2040, I think, is not consistent with economic history. Usually you have technology infusion that actually changes the equilibrium threshold level of GDP growth. And so you can imagine, how does this manifest with AI? If you can create an AI agent or a robot that can produce stuff, including more robots, then suddenly your capital becomes cumulative. You invest in robots that create more robots that create whatever physical artifacts you, the individual, want or need at that time. And so kind of the historically, if you go back, the 2 to 3% range is only a post-1950s range. Prior to 1900, we were more the 0.5% range or thereabouts, and prior to that, it was more 2% per year. And so kind of there have been these meaningful step changes in the growth rate of GDP, and you can assert, given the long track of history, that we should cross a threshold where we can do that at some point in the future. It seems very likely that kind of the technology revolution that we're living in the midst of is likely to kind of shift us into a new stage of growth. And so that encapsulates the complexity of the forecast.
I wrote an article recently for the New York Post about AI because a lot of the value is accrued to chip makers and big tech companies. And I think a lot of people are asking, like, what about the rest of us? Like, when does this start to manifest in my life? And I now realize, like, upon reflection, that some of the things I discussed in that piece are very similar to what ARK has been talking about for a very long time. Basically the argument I made was that this was going to have a big impact with health and longevity, that AI can identify diseases, diagnose problems before they arise, and so forth. That it's going to have a big impact on productivity, AI agents that can do things that people can do. That it was going to help to accelerate robotics. That it was going to disrupt creative industries, maybe for the worse, by replacing humans with AI chatbots that can write serviceable scripts. And who knows, in 10 years, maybe a Nobel Prize winning novel. I don't think so myself, but I'm willing to be open-minded to that. And then this whole question about like the singularity, as Ray Kurzweil described it, which is basically, can we have a melding of human and machine capability? And that anyway, I just thought I would share that with you. But on the last point, on this like longevity thing, car accidents are GDP plus, but aging is really GDP plus, right? Like the healthcare industry, like the amount of care that people get in the last sort of 2 or 3 years of their life. And if aging is something that we can't defer forever, but if we are able to spread it out in a way that makes it like less of a massive burden and helps to improve human life, obviously that being the most important part, what impact would that have as well? Anyway, so many things to unpack, but in the interest of time, since this is kind of a crypto podcast, I do want to talk about your public blockchain thesis. So I think Cathie said in January that she's got a target of $1.5 million for Bitcoin. How does she get there? I think people would love to know.
Sure. And I think it's detailed in our big ideas deck, but the working assumption there is that there is a, some meaningful share of gold holders kind of shift over or hold on to Bitcoin in a similar way, treating it as like hey, this is at least orthogonal to gold, and as a wealth kind of like, I'm trying to hold on to wealth that I know is going to be recognized as wealth no matter what the future operating environment is. Then Bitcoin is actually at least as good and maybe better than gold at doing that. And then across all of the other asset holders, there's a single-digit % expectation for shifting of portfolioes into Bitcoin. So across, sovereigns and kind of institutions and, corporate balance sheets. And so there's not like an aggressive expectation for adoption across, the rest of the, people who are kind of real allocators of resources. And then you cross that with just the reality of the supply-demand picture for Bitcoin, as in kind of because you have this decreasing supply, if you have a marginal change in the purchasing behavior to get up to a certain level, then you can end up with these, radical price dynamics that usually happen all in a burst. And that's I think, my rough expectation for how the market is going to move, as in, I think that the importance of the ETF launch was there is going to be generated demand from the ETF approval on the basis of now there are sales forces who are incentivized to go out and convince the Morgan Stanleys and the Goldmans and the JP Morgans of the world that this is something that is sufficiently sanitized that their clients can invest in it. And now the JP Morgans of the world, whereas previously they had zero financial incentive, in fact, they had negative financial incentive to allow people in. So they've spent a decade saying, hey, this is rat poison. They believe that, but they believe that because it was in the best interest of their institution. And so I think it's natural that it will take time for those institutions to, call it, elegantly degrade from those positions, and that the sales forces will over time erode kind of like the concocted and really made up barriers that have been invented. So there is going to probably be a motivation of flows like over time through that channel. But to me, the real important thing that will happen is it also means that the consultants and it's not just the flows that'll go through the direct ETFs. And same happened with gold, by the way, when it was approved. But instead, it becomes a socially, acceptable thing to allocate a small portion into Bitcoin. And it becomes something that is sanitized not just through the individual sale of the ETF, but somebody coming out with a report saying, hey, okay, if I'm approaching from a portfolio allocation standpoint, what is a rational amount that I should devote to this, either the individual asset or the asset class, given its historical performance, volatility characteristics, and expectations for value accrual. And they'll come up with a number, people throw out 5-6%, whatever. They'll have a number in that report that is in the, single digits, but more than 1% amount. And so then kind of the institution that's approaching this will be like, okay, so that seems reasonable. And they'll say it seems reasonable because suddenly it's been kind of blessed by the SEC is, okay, this is no longer rat poison. And so the ETF approval is important because it creates this sales channel into, a bunch of investors, but that heavily overlap with a retail channel that probably was already aware or was already using Coinbase to do it, but you get the boomers to invest in everything else. But more importantly is it creates a permission structure for larger allocators to really take it seriously. You don't have to do that much math around, well, what if people really take it seriously to understand that then there's like a big accrual event at some point in the future. And so people might feel some urgency to, we need to get in front of that. But I think that you don't have to make, so you can approach it from the percent allocation perspective of people. You can also look at what happened with gold upon the Bitcoin or upon the gold ETF approval in the US and how marginal flows changed relative to prior, and then run the math on how that impacts price. And just if the kind of marginal flows into Bitcoin improve proportionally, which brings them up to a level that's actually consistent with marginal flows into gold today, then you get at least $1 million plus a coin by 2030. And I think our official forecast is it's something like 750 to 1.5, and you can pick the midpoint million, but that's the way I think about at least the cryptocurrency space and what's going to be the marginal driver there.
And on the blockchain side of it, I think in some recent research, you were talking about how the growth of on-chain assets and application growth being turbocharged, if you will, by the scalability of these networks. And without going down that, I actually want to talk about that in the context of Bitcoin. Is any part of the thinking around Bitcoin's value proposition in the long term related to it being a platform for other assets and applications, or is it all or pretty much based on it becoming an asset that gains widespread adoption as a store of value, as a hedge, and so forth? How much of it is based on that tech side of it?
Well, I think it depends on how you define. I think of it as there is the cryptocurrency technology, which is basically Bitcoin, and that kind of Ethereum plays some role there. And then there's the kind of smart contracting technology where it's possible that kind of wrapping Bitcoin into collateral to use in smart contracts becomes more widespread and it does feed into and becomes that becomes a reservation driver for Bitcoin itself over time. That's certainly not the way we kind of derive or expect value to accrue there, but you can imagine a future set of scenarios where that happens. Now, if you're saying store of value and that's all that happens in the cryptocurrency side, rather than kind of there being ways in which it can serve as a medium of exchange and ultimately a unit of account, then I disagree. I do think that it's probable that some economies gonna get ripped into a Bitcoin world, whether they like it or not, in emerging markets. That there's like probably a chaotic set of responses that potentially happens out there that create Bitcoin really as a core currency for some countries. And if you think about like on a value accrual basis, and going back to the gold ETF analogy, the gold ETF did prompt some flows through the ETF channel. It did conditionalize the market to be like, oh, this is something we should allocate to. But the real appreciation event that like lifted it, there's like a 4 or 5x, was the global financial crisis. And then that caused a bunch of people to shove in, a lot of people to be like, oh, I really need to allocate to this thing. And that's, and I think within the cryptocurrency space, there probably does need to be some kind of external catalyst that's like kind of shoves people over the edge. And then right. it reaches another level and is bumpily flat for a while. Now, on the crypto asset side, we dimension kind of like a lot of value accrual, or the value accrual expectations there are really revolve around kind of like being able to transform kind of financial wealth into something that is composable and it resides in a token, and that the underlying kind of like, call it clearing and settling layer, the Ethereums or the Solanas of the world, accrue value not based upon, hey, this is a store of wealth, but based upon effectively the, call it dividends or the supply eating that they'll pay out as a function of facilitating the transactions that they facilitate. And then that people will ultimately pay on the basis of the yield that they get off of those assets. And so that's how kind of we end up with our value accrual expectations there.
Brett, it's incredible, frankly, that you can talk with such depth on all these different issues, because they are related technologies, but they also have their own, weird idiosyncrasies and language and verbiage and so forth. Like, how do you keep it all? Just sort of as a last question, like, how do you do your job? What's your team like? How are you resourced? How are you able to maintain leadership on these issues, which themselves are areas of like deep domain expertise?
Well, I think one, it's like, luckily technology is moving so fast that we are all constantly inexpert at the technologies. And so you just have to be in this. It's like, I think the value of expertise relative to the value of just being able to continuously learn has greatly diminished even over the past decade. Because kind of the tools that we have for learning are much better now than they used to be. And the pace of change is so quick, anybody that gets comfortable being an expert is almost certainly going to get run over by the train that's coming behind them as they like say, look at where I am on the track. And so like my major, like both own personal kind of like stance across the team is we always have to both understand that we don't really know and that we need to be continuously trying to know more. And so the way in which we do that, like these are all platforms of innovation. Wall Street often suffers from a failure of the imagination around these things. And so by publishing and sharing our material out, that's how we get back feedback that tells us, hey, you're wrong about this, you're right about this, have you thought about that? And so it gives us like at least a great kind of learning loop of feedback, figuring out where we're right, where we're wrong, republication, and that kind of like chain of sequence of events is how we stay current. And then we have a great analyst team who are at the technology level, working on cost declines, unit economic cases, and dimensioning how big we think these technologies are going to be. And so for me, like that process of taking what we think we know and then being forced to convert it into the actual numbers that result and the written language wrapped around it is the other mechanism by which you know what you don't know and you know what you do. And so like one of the, I think, real values that we add as a research team is there are often these like ideas people come to us with and they want to talk about them, they want to invest in them, and we're like, well, yeah, but we have to do the math first. Like quantum computing is an example that's come up again and again. Every time we've assessed it, like the cost decline is okay, but it's actually quite difficult to model. And often companies are producing metrics that aren't actually the metric of performance that matters to try to show that there's a cost decline when there's really not. And the unit economic cases are very challenging over the time horizon that we look at. And so it's hard for us to see how kind of like the pump gets primed sufficient to actually spin up those technologies into businesses that matter. Fuel cells and hydrogen is another one where it's like, you do the work and for the expectations to deliver, you need you really need some personal automotive use cases to come through. And it's always underwritten much worse than electric. And it will through the end of our forecast, as far as we can tell. And so forcing yourself, it's not easy work, it's hard work, to take the thing, I'm really interested in this, and convert it into the numbers, both helps you to understand like what the key drivers are, and helps to force you to learn. So Andre Karpathy, who's in the AI space, he has made this point, which I think is valid, that a lot of YouTube that purports to be learning content is actually just entertainment, because learning is hard work. People prefer not to learn. It's much easier to just sit back and be like, I'm going to bathe in this kind of sea of information without actually doing the cognitive process of converting it into things that capture meaningful insights. I think for us, it's really like continuing to do the hard work of learning and understanding the direction the world is going. Helps me to cross across all the technologies, but also helps the team to successfully underwrite positions over the time horizon that matters in markets, which is really a business cycle length. And so over 5 and 7 years, where are we going to be? We think that the technologies that we cover are going to accrue 10x in value over that time frame. And so then we think from a kind of investment perspective, it's like, well, you have to have a meaningfully kind of diversified, exposed set of bets against those technologies so you don't miss out on that accrual, particularly because those disruptive technologies might kill something that you hold as a core position in your core portfolios. So there's a real, think about Bitcoin and Bitcoin as an insurance policy. It's an insurance policy against geopolitical uncertainty and risk. Like, how sure are we in kind of the stability of the dollar and the US government? I mean, I'm probably less certain than I was a decade ago. I'm certainly am. And so then if you hold it as an insurance policy, like it pays, like that's great. It better pay, because your own personal life as a US citizen or a Canadian citizen, if the dollar really becomes destabilized, has really drastically changed. And so you need that asset to accrue to help cover over, even partially the life disruption and losses that you've taken as a result of kind of the destabilization event. So transfer that to every kind of industry, to banking, to automotive. And it makes sense to me that you should have a strategic allocation to disruptive innovation just to risk complete your life. You have a small business that's printing money. It'll be fine. Well, what if AI disrupts it? Well, maybe there's nothing you can do about that, but you could own the platform that's going to accrue in value in case that occurs. And so it is I think a really interesting time to be kind of both looking at technology and investing in technology, given how quickly things are moving.
I completely agree. A lot of people say, well, Bitcoin's risky. And I think what they say is it's volatile. Interestingly, its volatility is at the lowest it's ever been, measured by sort of standard deviation, like actual volatility. But the response to that is always like, it's volatile. And I suppose you could think of that as risk, but what's the risk of not holding it, right? What's the risk that something happens and it becomes, it's already extraordinarily valuable, but becomes an essential thing that you need to have. And I think that's a good way of thinking about exposure to innovation, as you've eloquently described, so I won't rehash it at all. So, Brett, thank you so much for the terrific discussion. That concludes today's episode of DeFi Decoded. If people want to learn more, like, you're a great follow on Twitter, so please share your handle here, and any other sort of sources of information, please feel free to to drop it now.
Sure. You can follow me on X at Winton ARK. You can also subscribe to FYI, the For Your Innovation podcast. I host that podcast, and we talk to technology leaders and really discuss more of these disruptive technologies, including all the DeFi and Bitcoin stuff. And you can visit our website at ark-invest.com. Alex, I really appreciated you having me on. It was an interesting conversation. Hope to see you in person sometime soon.
Sounds great. Thanks, Brett. Okay, that's it for this week. Remember to follow, and tell your friends about the podcast. It helps other people learn about it if they're interested in these topics. I think this episode is a great one to share with people because it shows just the breadth of cool stuff that we talk about here. So that's it for this week's episode. We'll see you next time. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.